Welcome to Live Economic News. Today, we're diving into this question: did the perfect economy just get better? In a world of ever-changing markets, policies, and global dynamics. Don't forget to hit that like button, subscribe to our channel. Norway boasts one of the world's most prosperous and well-governed economies, earning admiration from economists, politicians, and everyday individuals alike. The country, with its relatively small population of just under 5.5 million, was already among the planet's wealthiest by various measures. Interestingly, commendation for Norway's economic prowess often transcends traditional divides of economic, political, and personal opinions. However, a significant development unfolded earlier this year, reshaping Norway's economic landscape. In July, the nation revealed the discovery of the world's largest accessible phosphate deposit, totaling a staggering 77 billion tons in its northern region. This find effectively doubled the global supply of this rare resource, crucial for applications ranging from fertilizers to high-performance batteries and solar panels. The conservative estimate places the value of this discovery at around $24 trillion. Even factoring in extraction and shipping costs, this revelation has the potential to elevate Norway from a very wealthy and successful nation to the undisputed richest place on Earth, surpassing statistical outliers such as Monaco or Liechtenstein. The question now looms: will this transformative event materialize, propelling Norway to unparalleled economic heights? Let's delve into the details and explore the implications of this monumental discovery. The recent discovery is undoubtedly a boon, not just for Norway, but for the global community poised to benefit from enhanced food production and renewable energy sources facilitated by this newfound material. However, it introduces significant risks, particularly for nations already heavily reliant on the export of this resource, potentially facing substantial impacts from the newfound supply. Complicating matters is the geopolitical significance of phosphate, recognized as a strategic raw material by influential players worldwide. Adding to the complexity is the historical backdrop, where a previous country's discovery of a large phosphate supply catapulted its citizens to unprecedented wealth in a short span, only to witness a subsequent decline into widespread poverty. This cautionary tale underscores the importance of understanding Norway's plans with this newfound resource, shedding light on critical global economic issues such as responsible natural resource management, Norway's economic philosophy, and the distinctions between macroeconomic success and failure. As we unravel how Norway navigates this influx of wealth, we must grapple with the potential pitfalls of too much of a good thing and how it could inadvertently undermine the miracle economy. The decisions made by this relatively small country are poised to resonate across crucial sectors of the global economy. Join us on this exploration, where we analyze Norway's approach to wealth management, examine the intricacies of economic success and failure, and ultimately assess its standing on the Economics Explained National Leaderboard, a benchmark for economic prowess. Anticipated success is on the horizon, but can it clinch the top spot? Examining the global economic landscape reveals 4 categories: economies expected to fail and indeed do, those defying expectations to persist, ones anticipated to succeed but still faltering, and those aligning with expectations to thrive. Norway, once a modest economy heavily dependent on fishing, presents an intriguing case. Despite assumptions that wealth guarantees perfection, Norway's journey challenges this notion. Before the 1970s, it was not a particularly wealthy nation, trading with prosperous economies but relying mainly on fishing. The turning point came in the late 1960s when Norway uncovered substantial oil and natural gas deposits in the North Sea, altering its economic trajectory. This historical shift underscores the delicate balance between rapid growth and long-term stability. In the early 1970s, oil production in Norway commenced primarily under Statoil, a government-established company dedicated to extracting, refining, and selling the discovered oil reserves. Despite allowing private companies to operate in the fields, Norway mandated that the state must hold a 50% participation in every production license sold to these entities. This strategy was economically justified, asserting that the country's oil belonged to its people, ensuring they benefited from its profits. This approach not only attracted other oil investments, but also positioned Norway as a responsible player in the global energy market. Statoil, later renamed Equinor, expanded beyond extraction to invest in refineries, enhancing its ability to sell refined petroleum directly to consumers in Europe, the world's second-largest energy market at the time. Presently, Norway's extensive oil refining capacity has led it to import more crude petroleum, leveraging efficient facilities in countries like Sweden and Russia. The revenue generated from these natural resources has been substantial, with Norway historically retaining a significant share for its government and citizens, a departure from many other nations where natural resource profits primarily benefit companies rather than the state or its people. Norway's success in managing its newfound natural resources was partly attributed to geopolitical advantages, as a NATO member without the same struggles faced by countries post-Cold War. While a new channel with geopolitical experts is in the works to delve deeper into these complexities, Norway's small population ensured that revenue distribution wasn't spread thin. Redirecting natural resource revenues to the people was the initial step in responsibly building a successful economy, a task that Norway, as an established democracy with sufficient capital, navigated adeptly. Unlike some oil-rich nations in sub-Saharan Africa, Norway's independence in funding its extraction infrastructure limited external influence. Handling the challenge of using revenues for genuine economic improvement proved the most formidable. Various global strategies, exemplified by Venezuela, showed mixed success, as initial generosity in social programs and low taxes led to political instability and exacerbated by sanctions. Norway's approach sets it apart, demonstrating effective management amid a global landscape of challenges. The U.S. state of Alaska distributes a share of oil revenues to residents annually and imposes no state income taxes, a policy that, unlike Venezuela, didn't drastically alter the state's already wealthy and politically stable economy. Some countries use oil revenues for ambitious development projects to foster tourism and international business growth, potentially replacing the oil industry in the future. While this plan isn't inherently flawed, transparency issues often arise, making it challenging to discern if leaders are making investments for long-term national benefit or personal preferences. Additionally, the strategy of low or zero taxes on businesses and individuals, seen in places like the UAE and Qatar, risks a dependency on oil revenue. In contrast, Norway bucks this trend, maintaining high taxes on businesses, individuals, and economic activities, ensuring a more sustainable fiscal approach even after oil revenues decline. While Norway's national income tax rate may appear low at first glance, when factoring in regional taxes and additional levies, even moderate earners may find themselves contributing more than half of their income to the government. This doesn't even include sales taxes or the value-added tax, which is one of the world's highest at 25% for most goods and potentially higher for items like alcohol. Despite these seemingly hefty contributions, the impact isn't immediately evident in Norwegian cities, which are functional but lack extravagant infrastructure. This is because, instead of direct payouts or flashy projects, Norway channels these funds into a sovereign wealth fund currently valued at over $1.6 trillion. This fund has grown significantly, aided by inflation, robust investment returns, and strategic opportunities, such as becoming Europe's primary natural gas provider due to geopolitical events. If distributed, this fund would make every Norwegian one of the richest individuals globally. However, the government's decision to retain and invest in a sovereign wealth fund showcases its foresight in managing public finances and strategically utilizing resources. The Norwegian government's pension fund, or state pension fund, is not solely intended for individual pensions, but serves as a financial cushion for the country when it can no longer rely on oil revenues. Essentially, it's a retirement plan for oil, not the citizens. The strategy is to invest enough in the fund to compensate for lost oil revenues, a goal that is already nearing realization. The fund provides two significant advantages. Firstly, it allows the state to generate more income than if it had directly spent its oil revenues. Secondly, it imparts economic stability by acting as a shock absorber against unpredictable fluctuations in oil prices. By directing all revenues into the wealth fund, Norway insulates itself from the highs and lows of the international market, ensuring independence from oil revenues in the future. The fund also serves as a financial safety net, allowing the government to cover expenses during periods of low oil revenue without resorting to debt. Norway's relatively high tax rates contribute not only to economic stability, but also grant the government a tool for managing the economy. Taxes can be adjusted to stimulate economic activity or address issues like inflation and inequality, providing a level of control that is crucial, even acknowledged by libertarian economists as a significant strength. Taxes serve as a social contract between the government and its citizens, fostering engagement and scrutiny over the use of tax dollars. While Norway's model for managing natural resource wealth has proven successful, it's not a one-size-fits-all solution for countries with massive resource discoveries. The recent discovery of phosphate reserves in Norway, surpassing the value of Saudi Arabia's oil reserves, presents a unique challenge. Unlike the competitive fossil fuels market where Norway is one of many players, in the phosphate market, it would be one of only 2 countries controlling the supply. As global demand for phosphate grows due to its essential role in various technologies, Norway's newfound resource dominance carries strategic significance. Previously, Morocco was the primary source of phosphate, drawing attention from major global powers eager to secure a stable supply for their economies and technological advancements. Phosphate, designated as a strategically important material by the EU, the USA, and China, joins the ranks of resources like rare earth metals and uranium, subject to restricted international trade. Although Norway is not an EU member, the recent discovery makes it a focal point for major global economic powers, presenting both opportunities and risks. However, the impact is notably challenging for Morocco, a non-wealthy nation heavily dependent on exporting and processing nearly 25% of its economic activity and international trade linked to phosphate. If Norway enters the market with substantial extraction and sales, it could lower international prices, providing a more stable and business-friendly alternative for those seeking a reliable supply of this sought-after resource. While this benefits Norway and the global market, it poses challenges for Morocco. The potential revenues from this extraction may contribute to Norway's government pension fund, potentially tripling its value in the next decade, although it's still too early to confirm. Indirectly, each Norwegian citizen would have $1 million invested on their behalf due to the colossal boost this discovery brings to the country's economy. Despite the magnitude of this per capita windfall, it surprisingly failed to capture national headlines. Our research and conversations with locals revealed only 2 articles discussing the discovery, with one even mocking international news outlets for their exaggerated emphasis on natural resources. The almost nonchalant response to one of the most significant per capita natural resource discoveries in history can be attributed to a factor often overlooked by economists, particularly macroeconomists: culture. While our focus in economics often revolves around hard data and defined market policies, it's crucial to acknowledge that economics is essentially a social science that examines how individuals interact with valuable resources. In this context, the values held by people become pivotal, and Norway provides a compelling example of this principle in action. Norway, akin to its Scandinavian counterparts, boasts an egalitarian culture that has deeply influenced its economic systems. Notably, the absence of a mandated minimum wage is compensated by the remarkable strength of workers' unions, ensuring that nearly every worker receives a comparatively high wage. However, this egalitarian approach comes with a trade-off. Highly skilled workers may earn less than their counterparts in other Western European countries or the USA, particularly when factoring in the higher taxes prevalent in Norway. What are your thoughts on the cultural and economic factors influencing Norway's approach to its newfound resources? Drop your comments below and let's engage in a meaningful discussion. Thank you for joining us on Live Economic News. If you found today's content valuable, don't forget to hit the like button and subscribe to stay updated.